जितने भी पार्टिसिपेंट है सब अपने आप को म्यूट कर लें। शाह, फरीद, इर्तिजा, बुखारी, आसिफ खान, प्लीज अपने आप को म्यूट कर लें। सो ओनली गजनफर कैन अनम्यूट हिमसेल्फ ना ओनली।
Yes, guys. Do you have any point that we can discuss before starting today's session? Yes, ma'am. Okay, let's start today's session before project one. In last session, our topic was unrealized gain. So this is the again the same way what we did the calculation in the last session. Will continue from the same unrealized gain. So we already discussed the election for unrealized gain. Now there is another topic that is again associated with the same topic. So let's cover this topic. What is the topic name today? I just share in the group. So would you please confirm what is topic name? Yes, today we need some calculation also. So hope you will be. Anybody would like to come forward and explain what is the transitional gain? So we are discussing from return the election. So one election that we seen about the unrealized gain, and we discuss the unrealized gain and what are the election that we have to opt for that. Now for the same so we will cover today the transitional gain. This is another interesting topic and a little bit complicated topic where we need to be active and to understand the things. So our agenda for today is the transitional rule, transitional gain and losses that will not be taxable on certain asset and liabilities. This is our topic today. So first we will start with the excluded gain. Sell the asset in the first tax period or later at the gain, then minus some gain which arise at the start of the first tax period. So when we talk about the transitional gain, so what is the first point coming to our mind? Guys, my screen is, sorry, screen is not shared. Well, what is the first point that coming in our mind if we talk about, okay, the transitional gain and the first year in which we are saying that if some gain is arise, so we will discuss that part. I wish if you can quickly respond on that. Why, I think still some mic is unmuted. Would you please mute your mic and Mr. Asifan, would you please unmute your mic and explain what is your understanding about the transitional gain? Just a rough idea. So we'll continue.
Hello.
Yes, Mr. Asif.
Hi, good evening to everyone. Transactional gain, sir, if for example, two companies means, for example, uh, there are two sister companies and they having some properties or means intangible assets, and if they want to, for taxable income, if they want to sell for a higher price than the market value, and if they are transferred, so this a little bit knowledge I having, but completely I am unable to understand.
No issue, no issue. Anyone else that I'm asking from accounting point of view, I'm not asking of from the tax point of view. Just from accounting point of view, anybody else wish to explain? Okay, just quickly, the Asif Khan, Fahad, Sakir, Farhana, Fawad Aziz, Hamza, Tufail, Hussein, iPhone. I don't know that this iPhone, please mention your name because this is we considering as the attendance also. Ikra, Ramiz, okay. Then Irtada Bukhari, Khalilur Rahman, Injal, then Lahwera. I apologize if your my pronunciation is for the name is not appropriate. Lahira, Maimuna Irfan, Bashir, Muhammad Adnan Sharif, Muhammad Salman, Mushtaq Kapil, Shahab Farid, Shahzad Mudassir. Okay, Zoom user. Zubaira. Zubaira, would you please unmute this? Because why I'm asking this? Because if you're you show some interest, so I'm gonna start this topic. Let's, Ms. Zubaira, would you please unmute your mic and quickly just give the idea what you know about this?
Yes, good evening, sir.
Good evening.
Yeah, actually, this is a transitional loss, gain or loss. It's related to the previous year. So it could be anything. At any, for example, I will just explain about for last year, my provision for the employees was in excess or was in less. So now, if my audit already done and to start this year, first of all, I have to adjust the previous year if there is something related to the previous year adjustments. So that will be settle of the under transitions gain or loss because that will impact my profit.
Thank you. Thank you. Please mute your mic. Okay, let's start today topic, the transitional gain. And I believe today our 11th day, if I'm not wrong. Sir, today our agenda is a transitional gain and losses that will not be taxable on certain asset and liability. Let me take this. Now, but we have to calculate the excluded gain. The first point or the first exercise or the first learning today will be the excluded gain. What is the excluded gain? Now that just now Ms. Zubair also referred, the transitional gain, whenever we say, okay, when the new tax regime came, so the tax authority want to ensure and make the cutoff. Your first tax period is starting from, let's say, Jan to December is the first tax accounting period, and that is the tax period. So how tax authority will know from previous year your gain or losses, any balance or any balances that are coming from the previous year that will not affect in the current tax period or in the future tax period. So this is the point where the tax authority is given some guideline on the transitional gain, and they have some regulation on the transitional gain. So I share today the reference, the city law reference also regarding the transitional gain. So which ministerial decision or city law clause or article is dealing with the transitional gain? Please quickly respond in the message. So now the hello. Something is. Please mute your mic. I appreciate you mute your mic. Let's start the qualifying asset and the liability. So first today we are covering qualifying asset and liability, in which we will gonna see what is the immovable property, intangible asset, financial asset, and liability. So to cover the transitional gain, so today we will see must we use the cost model, because the asset that we're gonna discuss and that will have the transitional balance, that maybe the value before the tax period is a different and after the tax period is a different. So this is the cutoff that we have to establish. Now we'll go through the tax return. Why we have to calculate this? Because the FTA, they will ask the calculation, or in simple word, we have to prepare the opening balance sheet for the tax authorities. One balance sheet under reporting we are preparing for the audit purpose. But again, we know that our audit report and the tax calculation, city computation will not be the same. Always even the tax regulation is mentioning that we have to prepare the audited report if our turnover is more than 50 million. For the mainland companies, for free zone is always mandatory regardless of the turnover, but the mainland companies, but if your turnover is less than 50 million, so then it's optional, and you can also opt for the IFRS SME also. But on the other side, we also know that without making the financial statement, without closing the books of accounts, we cannot proceed with the city return also. So on all the way, we have to close our books. So now in the first return, we have to submit the two things. One, the opening balance. That is that main key area for today, the transition, because the transition tax regime is coming. So they have to establish the opening balances, and we have to give the calculation, whatever because tax authority is saying you may not transfer the losses from the previous year to current year, or vice versa. You may record the revenue may belongs to the current tax period, but you are saying, okay, this is the first tax, the last tax period, the last accounting period is before the tax period. Whatever we can adjust, we will adjust over there. So here the FTA or the tax authority, they want to ensure So it will be on appropriate way as per the accounting standard guideline. So we will do the costing in the first tax return. We will submit all the detail. Let's see the return. In return, which part is dealing for this? This is the election. So this is the same election under return. When we opt for the, when we start the corporate tax return, so this option will be there. So we already discussed this transition unrealized gain election. And before that other election, we also go through now transitional rule. Under the transitional rule, so what are the guidelines? Here that as per the return, the one election is shown. Has the taxable person held any qualifying immovable property? Now they are very specific. They will ask about three things. So let's go through qualifying immovable property, qualifying intangible asset, or qualifying financial asset, are the qualifying financial liabilities. So here the main point, qualifying immovable property. So what is the first word is coming in our mind? Immovable property. Normally we are coming our mind land and building. This is the maybe the some based on the industry or the business operation. Vending machine also can be the qualifying immovable property. Vending machine, we all know this is the in any mall or somewhere we go, there is a vending machines. We put the money and take out some juice and some chocolate or something like that. But this is if the company doing the business in that industry, for them maybe is a number of assets, so they have to calculate that asset also. So qualifying intangible asset. What are the qualifying intangible asset that based on each industry they will vary? But anyhow, these three, the qualifying, let me. First, the qualifying immovable property. This is our discussion. Then the qualifying intangible asset. Then qualifying financial asset and liability. Okay, we are considering in the same words. So what will be election? If we say no, the return further option, the further field will not be open. If you are not opting this option, this election, it will not open. No further implication. But again, all the election, the first return is a very important and critical, and I appreciate all of the professional and the consultant also do the appropriate analysis of the business and then do the return preparation. Because most of the election are the something and the transitional rule, they have the impact in the future return also. To avoid the final penalties and inconvenience for the employer or the company where you are working or the client, it will be appreciate if you do the due diligence and then proceed with the return preparation. Now the next, if we are saying we are choosing the qualifying, the election transitional rule for the qualifying, in the qualifying immovable property, intangible asset, financial asset, and liability. The moment we opt for the yes, so the next three field will be added in the return calculation. Why I'm adding this return part along with the each topic, because we have to know, we have to realize or understand what is the importance of the topic that we're gonna study today or we're gonna learn today, and where it will be helpful while the return. Please mute your mic. One of the participants, the mic is unmuted. We appreciate it. Put your mic. Now we opting the transitional rule, yes. Okay, so now the three field will be added. So what are the three fields? Let's move to the next. qualifying immovable property. The first point. This is our first point, qualifying immovable property. So now once we opt for the election, the first point, qualifying immovable property, is the taxable person making an election to adjust the taxable gain for the gain recognized on qualifying immovable property? We will understand what is the immovable property. But as of now, just take the concept, what is the return requirement in terms of the topic that we're going to discuss. Is the taxable person making an election to adjust the taxable income for the gain recognized on any qualifying immovable property owned prior to the first tax period? Prior to the first tax period. In the simple words, mostly we are familiar with the name of opening balance. Okay. So yes, in corporate tax return, we have to submit the opening balance detail also. We have to do the calculation and submit over there also. If we say yes, so then next he will give us the taxable person can make irrevocable election to exclude the element of the gain on the disposal of immovable property prior to the first tax return. See, most of the election, except one of the election, most of the election are irrevocable. And normally along with each election, the word irrevocable is used. What is the meaning of irrevocable? Irrevocable means the first return, once you opt for the election, later on it cannot be changed. So this is the critical point, and this is the important point while we have to do the due diligence for the first return. And the first return will take the more time, more understanding. If something went wrong and later on you will keep continue on the same fashion, even businesses suffering with that. Except one scenario or where you are able to justify, but that is not very easy. The FTA may consider the election to be a revocable election. So if we opt for the yes, under the accounting adjustment, where this adjustment are detailed to be put in the return under accounting adjustment. Under accounting adjustment, transitional in case yes, section 4 accounting adjustment transitional, below box will be open. We opt for the yes. Now he will ask the detail. Has the taxable person disposed of any qualifying immovable property during the tax period? Means the first tax period. Why they are referring this? Anybody would like to explain why this question or the clause or the topic that FTA is asking? Has the taxable person disposed of any qualifying immovable property during the first tax period? Would you please quickly just reply? Because they want to ensure if you have the disposal, then they will ask, okay, give me the detail of the asset is purchased before the first tax period. So give me the detail of that. How much the transitional gain or loss we can exclude from the city computation. So if we say no, so no further calculation. But the moment we opt for the yes, so then we have to put the detail. We have to put the detail. We have to give the amount that is the gain that we have. Adjustment in respect of the gain on elected immovable property prior to. See, if we purchase in the first year and sold in first tax period and sold in first tax period, that is not the asset that we are discussing. The important part or the important is the owned prior to the first tax period. This is the concept of the transitional. So we will keen focus on asset is purchased before the first tax period. Let's go to the next. Now this is the second, qualifying intangible asset. Immovable property, the first, now qualifying intangible asset. So what are the intangible assets? we will discuss after this couple of slides. Is that taxable person making, it will go in the same way that we go through the previous, it will work in the same way. Is the taxable person making an election to taxable income for gain on all qualifying intangible asset? Again, main part owned prior to the first tax period. Same, if we opt for no, it will not give you the further calculation. The moment if we opt for the yes, the further box will be appearing. Now, if we opt for the yes, then the next question will be appearing, has the taxable person disposed of any qualifying intangible asset during the first tax period? Yes or no? If no, he will not ask the further question. If yes, so the further same box will be appearing. So we have to give the how much the gain in the first year we have it. Now the third, qualifying financial asset and the liability. This is the third point. Again, it will go in the same fashion. Is the taxable person making an election to adjust the taxable income for the gain and losses on all financial asset and or qualifying financial liability? We will use the qualifying, yes, the qualifying financial asset and liability. This will keep it in the same fashion. Again, it will be same. If we opt for the yes, so system will open the further detail. This is the same fashion that if we took from the FTA portal and we prepared in the for the training purpose. The moment we say the yes, then he will ask, okay, do you sold any asset in the first year? If we say no, it will be closed. If we moment we select yes, he will ask, give us the detail. Now here he will asking the another important part, adjustment in respect of the gain on qualifying asset. The word gain, the second is the loss on prior to the first tax period. So here is the important part, and from the professional or the consultant point of view also, if we make our chart of account in the fashion, we will record separate line item for the gain on financial asset and the separate chart of account on losses. It will be easy to be report in the return. Each system have different reporting. Maybe other way around, we can fix our accounting system and get this report, or instead of in the same account we give the profit and the gain or losses, and later on at the end we have to pull the information and segregate. But it's more appropriate if we have the separate chart of account, because this data we have to keep for the 7 year after the end of the relevant tax period. So it will be more advisable if we make in the system alignment as per the corporate tax. The data will be can be pulled out from the system in the same fashion that we required in the corporate tax return, because in the long term that our system will give us the appropriate information, but if we do the manual calculation and manual Excel sheet or other documentation, that may will not be available in the future. Maybe data is lost, or the people are working in the organization that is not anymore. There are many factors that you guys may be understanding the point I'm trying to highlight over here. Let's go to the next, transitional rule. Now we are coming to, finally to our topic today, the transitional rule applying on intangible qualifying asset and liability, which is recorded on the cost model. Here our concept is the cost model. Mostly we will go through the cost model. Let's see the qualifying asset. The transitional rule, why we are looking for the cost model? Why we are not looking for the fair value? Anybody would like to explain this point? Because I want to emphasize on the cost model to highlight why, because this transitional gain or loss will be appear in our calculation or the city computation, the asset that we recorded on the cost model. If the asset is already on the fair value before the first tax period or the opening figure of the current tax period, so then we don't have to do the calculation. the gain and losses. Why we are going this all calculation? To look into that, how much the excluded gain and how much the taxable gain. The whole concept is that FTA or the city law is saying, okay, if you have the asset before the first tax period, you own the asset before tax period, and later on in the future, if you sold the asset, the first condition, if you have the asset prior to the first tax period, okay, then the second is at the cost model. The third, in future, the asset expected to be sold at profit or at gain. These are the three component or the three condition, or these are the three basic understanding we have to keep in our mind while considering the transitional rule. Because if asset is already on the fair value and coming in the first tax period on fair value, so then there will be no topic of the to calculate the excluded gain. Let's see the qualifying asset. The first condition, qualifying asset, the first condition, cost model. The qualifying asset must be at a cost model. The second is purchase before first tax period. Purchase or owned before first tax period. And third, expecting to sell at gain in the first tax period or in the future tax period. These are the first condition under the transitional rule for the qualifying asset, while we're gonna understand today, while we're gonna learn today. First, now I appreciate if you guys active and send in the chat also what are these conditions. Quickly, just write the short word, the cost model, on before the first tax period and expected to the sell. These are the first three conditions. Let's see the second condition. The second condition for the qualifying asset, it must be the immovable property. It must be the immovable property. So now what is the immovable property? The PPE for own use, the company is using. Then investment property. This is property, plant and equipment, property, plant and equipment on use. Then the second under immovable property is the investment properties. Under investment property, what we are looking for? Under investment property, what we are looking for? Land and building held for rental and capital appreciation. Do you agree with me on that? What is the accounting standard is referring over there? Qualifying asset, the first condition, the immovable property. Under immovable property, we are looking at property, plant and equipment for own use. And this is, any business without PPE, it will not be in operational. The importance of this, the importance of the transitional rule, now you can understand every business have the property, plant and equipment. Even small business or the big business, even the SME sector or the multinational company, all they have PPE. On investment property, maybe only some business they have and some they not have. But how about the PPE? So if you have the asset in your balance sheet prior to the first tax period, so you have to do the transitional gain calculation, gain or loss calculation. So these PPE are the qualifying asset. On that, we have to do and this, okay, if we have the property plant in our books, so what is the first requirement? This asset would be on cost model. And this must be purchased. How to test this? How to test this? We have one plant, okay, that is the manufacturing company, he have the plant. So whether this plant is a qualifying asset or no. How we test the plant, we will say it is recorded on the cost accounting model. Then second, we will say purchase before first tax period or owned before the first tax period. Okay. The third, we will see expecting to sell at gain in the first tax period or the future tax period. Then we are coming to the next part, the immovable property. Immovable property, we will go through an investment property, land and building, and most of the, even the SME sector or even the multinational company, they have the land and building. Most of the companies are the big industry, they have their own land and the building where they manufacture, they construct their warehouse or their plant or offices. This is the for own use. But on other side, they have the land and building held for rental under investment property. Which standard is dealing investment property? And then capital appreciation. Hope you guys are understanding the point up to here. We'll go through the further also and see. Next is the intangible asset. Under intangible asset, which are the assets are coming? The software. Do all the companies, they are not using the ERP? Focus, they are not using the SAP, or they maybe done their own in-house the ERP. So they have some cost for the such software, the accounting tool, then the copyrights, the patents, landing rights. What are the landing rights? You already have the at airport, you have some right at the certain airports in the worldwide, so that will be your right. That is your intangible asset. You already paid some certain cost against that. So this is the intangible asset. So this intangible asset will be part of the calculation of the transitional gain. How we close our books if we are not prepare our the financial statement from the transitional rule perspective. Anyhow, let's move to the next, financial asset and liability. The third, the financial asset and liability. Financial asset and liability we'll see in the next slide, but let's come here, the immovable property. Immovable property, land and building, vending machine, air turbine. Air turbine, mostly we are familiar with this. What is this? So these will be our PP that we already have, or that is part of our, most of the businesses, some of the part will be under immovable property. And now how you were gonna record? So if we have these assets, the first thing we have to check the cost accounting model. These assets are recorded in our books on cost accounting. Second, asset is purchased before first tax period or owned before first tax period. Third is expected to sell in the future in the gain. What does this mean, expecting to sell in the future? Because if we already know the asset is already, the completed the economic life, so it cannot give us the future gain. So why we gonna choose this election? So this is the mean of that. This is the test that you have to do for while considering the transitional rule. So under PPE on use, transitional rule apply here only on the cost model. If we record on the cost model, but if we have that asset on revaluation model, then no. So what we are looking for, the cost model. On revaluation model, what is the mean of revaluation? Just for our sake of understanding. Because if the asset already revalued on his current market value before the in the first tax period, the last accounting period, that is the opening balance of the first tax period. So which means this asset, there is no, we cannot do any calculation on the exclude gain. Because asset already recorded on the fair value in books of accounts, so we cannot say any gain belongs to the previous years. It will coming in the future when asset is sold. Because that gain we already recorded in the previous year. But on the cost model, even the asset market value is more, but we didn't record, because the cost model we didn't record in our books. So maybe we have the assets, but market value due to different factor is changed, and we can sell asset at more. we expect asset can be sold at more, at gain. So that is the only, because that gain have the two parts. One, before the tax period, before the first tax period, and the second will be after first tax period. Because asset can be divided into two, we have to calculate the gain. If, let's say, I'm just gonna say, if one asset is sold at gain, just simple understanding, 10,000. Asset is sold at the gain of 10,000. So what is the asset was acquired? What is the total life of the asset? Let's say that 10 year. So 10 year is the total life of the asset. And here we will say the 5 year before first tax period. And the 5 after first tax period. Now this gain we have to split before first tax period and after. What is this before? This before means this is the excluded gain. Excluded gain because we hold the asset or we own the asset before the tax regime. So that is not subject to city. So this is our whole topic calculation. So we have to do the appropriate calculation by applying the city regulation and calculate the excluded gain. So this gain we will adjust from our city computation. This is not subject to tax. So let's move to the next. Same point here under investment property also. Same point under investment property also. Under investment property also, if transitional rule will apply if the asset are recorded on the cost model, if the fair value, no. Under fair value or the revaluation model, because the asset already on their market value. So then there will be no excluded gain. Then the next is the intangible asset. We will see. Next slide. Yeah, before the tangible asset, we already go through the software, copyrights, patents, but the financial asset and liability. Let's see the financial asset and liability. Just for our sake of understanding, if we talk about the financial instrument, what is the financial instrument? Financial instrument is the agreement that give rise. One side is the asset, another side may be the liability. Am I right? The financial asset, if we choose the financial asset, the word financial instrument, the financial instrument. Would you please give me quickly the example of the financial instrument? As most of our participant belongs to the same accounting profession. Please share one of the example. Dear participant, please be active in the session. Yes, Mr. Shahab, thank you very much. You mentioned more details. Okay, guys, let's see. Financial instrument is an agreement that gives rise to asset of one entity, because same time that asset will be the same financial instrument will be asset of one entity. On the same time, it will be the let me equity or liability to the other entity. Equity or liability to the another entity. When we have the financial instrument, this is the asset. The same time, it is the asset, and the same time, it may be the equity or maybe the liability to another entity, another company. Now this next, the financial asset accounting. Okay, let's see the financial asset accounting. How we do the financial asset accounting? Equity investment and debt investment, the same concept, because how we raise the our funds. Financial asset here, the equity investment. Let's go through the equity investment. Purchase of share of another company. If we purchase the share of another company, so as the equity investment we made. Fair value through profit and loss, short term. Unlisted stock at cost. Fair value through other comprehensive income, long term. Under equity investment, what is the our area that we will discuss or cover under unrealization gain? Only the unlisted stock at cost. The word fair value, we said it will not be applicable or required to calculate the excluded gain, because fair value means the asset already on his market value in the books of accounts. You agree with me or no? The fair value through profit and loss. You say yes or no? Yes or no? If the asset already recorded on the fair value, so then there is no gain that will belongs to the previous year come in the future year. There is any gain if asset already on fair value or on the revalued amount, okay? So there is no scenario or the calculation that we do. The gain belongs to the previous year before tax regime may come in the first tax period or the future tax period. There is no concept. Our understanding so far, there will be no scenario it will come. Now only the one scenario that where our assets are at the cost. So that cost, if we have the equity investment, purchase the share and unlisted stock, what that mean of unlisted stock? What that mean of unlisted stock? Anybody want to explain what is the definition of unlisted stock? So Ms. Kindle mentioned not traded on the stock exchange. If the moment we say not traded in the stock exchange, which means the value may be not market value. Because if traded on stock exchange, so daily basis on every second or every moment, the value of the shares are keep updating, right? So the unlisted stock that is not traded, which means that market value and the cost, the shares we record in our books at cost, because the market value is not frequently available, or we record when we purchase, we record at the cost. Okay, now the next part, the debt instrument. Under debt instrument, just now, I think one of Mr. Shahab mentioned the bonds, shares, debentures, sukuk of another company receivables. Okay, this is the debt instrument. So now the debt instrument, which part will be more relevant or also more applicable or more common for all the companies, for SME or the multinational? Would you please quickly reply in the message? Which part of the debt instrument will be associated or concerned for all the organization, all the companies who are taxable entities that is relevant to them. Please, quickly. See, the mostly, if we say the debentures, okay, or the receivable. How about the receivables? How about the receivable you're understanding? Debenture of other company are receivables is the commonly we are known also, and it is commonly concerned most of the organization also. So we have to see amortize as cost model, amortize at cost model. Here no, here no, this one no, this one no. So now we have the only two scenario there. The transitional rule is relevant, because now what we are learning so far, we first from our organization, our financial, or the audited report, or the from client financial statement, we have to see which area or the which financial line item we have to our consideration under our consideration for the corporate tax. Yes. Okay, now let's move to the next. I'm not sure most of the participants we already completed 10 or 11 session approximate. The information or the training or the material is prepared is from the consideration of the city return, as well as covering the most of the topic of the corporate tax also, and trying to be summarized in a way that is understandable or that will be the productive. But I appreciate if you guys also invest your time also and further read the relevant article that the city law that we are discussing. So just if you quickly respond, so far, what is your understanding of the transitional rule? Are we understand the basic concept of the transitional rule so far? Okay, thank you guys. So let's move to the next. Okay, here I'll just make the alignment because still some animation is not completed. Okay. Ministerial decision 120 for the transitional rule. So transitional rules, 3 tests on qualifying asset and liabilities. Qualifying asset and liabilities. Actually, 3 tests we will go through. It's not on the transitional rule 3 tests. We have to understand what are the 3 tests. The first, we discussed the measurement tests, because while considering the transitional rule to be applied on any asset, okay, so what are the 3 tests? We already learned before starting the topic, we already learned that part. Measurement test. Measurement test, asset and liability kept at the cost model in the accounting. Did we understand before coming to topic or no? Transitional rule 3 tests. First, measurement test, asset at cost model. we already know. First, the cost model. The second, the holding test. Holding test, asset held before the start of the first tax period. Asset hold before the start of first tax period. We also know we already understand the whole concept of this. Asset is purchased before the first tax period. Third, gain test, expected to be sold at the gain during the first tax period or the future. Why we are saying if the gain will come, so then we have to worry about that. We will not pay the tax on that gain, because that gain have the two portion, one excluded gain and one is taxable gain. So this is the whole topic we are discussing. And this election is the irrevocable election. At the first tax return, apply on all qualifying asset and liability. Apply on all asset and liability. And along with that, I share already FTA tax guide. FTA tax guide. This is the name you search in the Google accounting standard, and this is the guide code also. Because we all professional knows mostly the city law is referring to the applicable accounting standard, but here they give the guideline also how the accounting standard implication or application will be there. If we have the ambiguity, so just go through that and see on each topic how they given some example for the understanding and they apply over there. While preparing the corporate tax return, this will be one of the tool. This will be one of the tool, okay, where you have the ambiguity. What is the accounting team or what is the our auditor give the inferential statement? What will be the implication and how it will be impact in the city? Please go through. It will be helpful for you. Now the first we said the test, okay, 3 tests we already made. Then the second is we already said the qualifying asset. So what is the qualifying asset? The first is here. Transitional gain on immovable property. We will go through in detail. Then the transitional gain on the asset, intangible asset. Then third is here. Transitional gain or losses on financial asset and liabilities. Is it the same that was shown in the city return? Would you please confirm it is the same thing, that the same 3 point that we seen in the city return? Yes or no? And it is same that it's in city return. And so far you understand why we are investing the time, why we are investing the time on transitional rule. Why we are investing? Do we need to understand to submit or to prepare the corporate tax return? Okay, now we will go through this transitional gain on immovable property. Now this topic will take most of our time. Transitional gain on immovable property by 2 methods. Okay, so what are the 2 methods? 2 methods to calculate transitional gain at the start of first tax period is I already made in yellow. The start of first tax period, that will be excluded from the gain on disposal. The definition of the transitional gain means the gain arrive at the start of first tax period, that will be excluded because that gain belongs to the previous year, the asset held before the first tax period. So whatever the gain that belongs to previous year, that will not subject to city. The whole understanding is that. So now the first method, excluded gain. Okay. The first method to calculate the excluded gain, already yellow highlighted, excluded gain. The whole point we are saying, we will understand the excluded gain. The definition of excluded gain, we don't want to pay the city. Okay, we do not want to pay the city tax on the excluded gain. So what we do, okay, in the first year, even the asset is not sold. So we will calculate the gain. How we calculate? We'll do this deemed sale at market value at the start of the first tax period. Deemed sale market value at the start of the first tax period less. This is the another important point to be understand. Less higher of original cost or net book value. Okay, so we have to take one of them higher of from original cost or net book value. So why we are taking the higher of? It is good for us or no? It is good for us or no? Sales are deemed, hope you understand the deemed understanding, because asset is not sold, but we are considering or we are assuming that asset is sold and we already know the market value of the asset. So one of the participants during the training, he said, okay, how we know the deemed sale or the market value? So I just give the example. If you have your personal vehicle, your car, okay, if you want to sell that car, so how you will check the market value of that vehicle? Because he's saying, okay, I'm not part from the buying and sale of the car. So how I'll come to know the value of that car? So I'll just give the simple understanding. I said, normally the mostly people go on Dubizel and check the value of the similar asset, similar car or model or the mileage or something like that. You will get some market value. Okay, this asset, this model of the car, this much is the expected price. So this is actually, he is not selling, but he want to know the market value. This is one of the understanding we can take the value. There is a many way. This is the one of the just for understanding. Okay, now here the tax authority is saying market value at the start of the first tax period, then minus, because we are calculating the gain and the excluded gain, higher of original cost, the asset on which cost we purchase, and net book value. What is the net book value normally? Net book value means we have some depreciation. So original cost minus depreciation, the net book value is a lower. So is there any chance, is there any option, or is there any scenario where the net book value can exceed the original cost? Guys, quickly respond. Is there any scenario? Ms. Itzada is saying need to provide it for the deemed sale price. Need to provide the deemed sale price. I did not get this point, but anyhow, this point will be covered. This point will be covered in the example. Okay, there is a revaluation. Okay, but the revaluation we already said if asset is already revalued. Okay, if asset is already revalued, it will not be part of this calculation. But anyhow, let's we may argue on the on the accounting standard or IFRS, but that is not our primary topic. But the concept you are understanding, the highlighting the area that where we need to do our assessment. Higher off, the important point is the yellow in higher off. Just take the higher off, and normally is the original cost. In most of the cases is original cost. There may be some certain scenario, net book value will be more. So if we take the original cost, because if we take the original cost and the minus from the deemed value, so which means the gain will be lower side. The gain will be lower side. So here the next point, the common point that we are saying how we are get this market value. And mostly the companies are the who have the the real estate, the land or the building, warehouse structure. Even we have mostly the expat, they have the lease land, but they have the warehouse structure or the factory structure. They already took the 50-year lease and they built the warehouse and they built the factory. So that also their real estate, the property. So now there is a two option. One, the valuation. At the first of the tax period or the last accounting period end, that is, we are assuming that January to December 24 is our first tax period. So 1st December 2023, if we have the warehouse or if we have the building, we can do the valuation. We can say, okay, this is the one of the option. Direct method, this is the direct method. We will go to the RERA and we'll say, okay, this is our warehouse, this is our building, or this is our land. So we want to valuate as per the 31st December 2023. The value of 31st December 2023. So they will give you the valuation of that asset at that date. So now the people will come in and the question is coming, how it will be? How it will be now? I'm in the 2024. How I can get the valuation for the previous year? Any participant have the real estate or any asset that they revalued, considering the corporate tax implication? So now here saying the valuation, we cannot just go to any of the valuer and they ask them to value our property and we book the value in our city return or in the accounting also. Why? Because most of the people will try, they are expecting if we give them more value, if we giving the more value to our real estate or to our asset, which means so our future upcoming gain will be reduced and we will not pay the tax on that. And we commonly heard from the market also, people are paying some price or some cash or some funds to get the more valuation of their properties or their asset. This is against the tax regulation. It fall under the CAR rule, okay, anti-avoidance of taxation. But we are not recommending, but still people are doing. But on the other way, maybe there is a possibility you approach to the relevant authority in terms of the Dubai. If we are discussing in terms of Dubai, we are discussing the RERA is one of the authority who will give you the valuation of their real estate. We cannot go any of the random valuation company and get the value and submit to the FTA and claim that, okay, this is our value for this asset. So we want to go on the valuation basis as a direct method. And this much in future, if whatever the gain is arriving, so considering this, it will be exempt or excluded from the city. No. This certification certified by the relevant competent authority in the state. State means the UAE we're discussing. So whatever the valuation we are arranging through the competent authority, that is the RERA, maybe the RERA will not do themselves the valuation. They will refer their approved valuer, but they will certify that valuation report. Hope you understand this point. This is the first point, direct method. Okay. The second is the proportionate method. Second is the proportionate method. True method, excluded gain. Again, the same objectives to calculate the excluded gain. Now, the proportionate method. Here we said the deemed sale. Okay, here we are considering the deemed sale. Here we are saying sale, actual market value, because this will arrive at the date of sale. Okay. If at the date of sale, if we're saying at the date of sale, the deemed value means the market value, but at the same rate we are selling. So we might consider, okay, this is the actual value of the sales. Actual market value at that we sold. Actual market value at the date of sale. So here again, we have to remember less higher of original cost. So mostly the original higher of original costs are the net book value. at the start of the first tax period. So mostly we will take the original cost, but there may be some circumstance net book value is on higher side. So the higher of we will minus. We will take the example, then our understanding will be refined. But so far, are you with me so far up to this understanding or no? Guys, quickly reply. Are you understand so far the concept? Or if you have any point that you want to ask, please let me know. I assume most of participant is understanding. Okay, now the second method, the proportionate method. The proportionate method we are commonly known the split method. So the proportionate method, how it will work? Here the number, whatever here the gain. Okay, the gain multiply number of days property is pre-owned at the first tax period. Because now we have to what we need to calculate excluded gain. What we are looking for excluded gain. So whatever the if we did this second method on the date of sale minus the original cost. So what is we have gain, and now the gain. How much is the excluded gain through the proportionate method? Okay, because this gain arrive at the date of sale. This is not at the and this why this is the start of the first tax period, because we calculate the gain at the start of first tax period and we said this is the excluded gain. But because if the market value at the start of the same date and we are excluding that, so which means we already excluded the gain that not subject to tax. But here the gain is arriving in the future when asset is sold. So we now here we have to see how many days, the number of days property is owned at the first tax period, before tax period. Okay, just now we earlier took the example. Let's say the asset value, same example, 10-year is the asset life, and here we have to see the 5 is the before tax period and 5 is the after tax period. Okay, so now just take the 5 pre-owned and total number of days, okay, of the ownership from the date of purchase and from the date of sale. What is the total number of days? Keep remember here the word days is used, not the year. FTA given the example and in the city law relevant clause also they use the word days. So that's why I highlighted the days. So we have to convert into the days and calculate accordingly, because other way around fraction may be there. So number of days before and total days into the gain. This will be our excluded gain. Excluded gain not subject to city. Okay, let's move to the second part. Up to this, we already covered so far. Now the second, this one is now we're going to discuss that. Transitional rule on, the transitional gain on the intangible asset. Transitional gain on, this is our topic. Now we're going to discuss that. So here is only one method. In movable property, we have two methods, and here we have one method. Hope you guys noting the point wherever highlighted for understanding. Excluded gain, the same concept. Actual sale, here this method is not there at the first year. Okay, direct method is not there. Excluded gain, sales actual market value at the date of sale. So direct method is not there. Only the second method, the proportionate method, is available. Now the second, higher of original cost or the net book value. At the start, again, the same concept, the higher of. Any difference so far? The same proportionate method we are using here. So if simply we say under immovable property, we have two methods to calculate the transitional gain, but under intangible asset, we have only the proportionate method to calculate the transitional gain. Just to close the understanding, here the proportionate method only, same again, the same. But here one more point. For intangible asset, normally we know the some copyrights, patents, software, okay. So here they mention the number of days of intangible asset is pre-owned at the first tax period, the same formula, total number of days of ownership. But what is the additional thing? This is the additional thing. He's saying intangible asset owned prior to the start of the first tax period, maximum 10. Which means you can exclude the gain up to 10 year only. Let's say you own the asset for total asset life is a 20 year and you sold and owned 14 year before the first tax period, and after the first tax period owned 5 years. Now he's saying you can exclude the gain for only the 10 years, not for the 14 years. If it's a 9 year, you can claim the 9 year, but the limit is that only 10. As you note down under intangible asset, the maximum limit for the pre-owned is a 10 year. Less than 10 year as per actual, but maximum cap is a 10 year. Rest formula is same. Now we will go to the next, that transitional gain and losses on financial assets and liabilities. Again, here the excluded gain. What is we are trying to calculate excluded gain? The whole calculation is excluded gain. Transitional gain means excluded gain. Our concern, how much will not subject to tax. And if tax authority is concerned, taxable person should not take more gain as excluded to ensure that they have the transitional rule. Sales deemed market value at the start of the first tax period. The important point, at the start of first tax period, okay. This is the direct method. This is direct method, okay. Less the original cost. Less the original cost. Here we did not use the higher of. Here we did not use the higher of on net book value. Simply we are using the original cost. Guys, this is the important point that I hope you guys note down, and I already key point highlighted in yellow. And applying this formula, so this will be our excluded gain. And we already seen the financial asset and liability, what are the area. Okay. So here we will go as per actual. As per actual. Now the not higher of net book value and original cost, this we already understand. So what is the, if I link over here, financial asset and liability. We already go through, but here again I added equity investment, purchase of share of other company, unlisted stock at cost. If at a cost, this is the financial asset. This is one of the examples. Second is the liability, debt investment. Okay. Debt investment, equity investment and debt investment. Debt investment, purchase share, bond, debenture of other companies, amortized cost. Again, the cost model. Guys, if you have any point, please let me know. Let's go to the next and see the one of the simple example. The example, the first he mentioned, to simplify the example, mentioned the cost model. This is what we're looking for. This is the one of the our requirements for the transitional gain. For the immovable property, profit before tax they already given. Gain and losses on realization basis elected. Cost of immovable property. Immovable property is there. Cost model, immovable property. The first we said the cost model under transitional rule. The second, I'm repeating again and again because to summarize and you refresh that, this is what we need under transitional gain. While applying the transitional gain, the first point we have to see the cost model. The second is on before the first tax period. Third is expected to sell in the future. Cost model is there. Now the second is the immovable property. When we purchase 1st January 2021. So first tax period is 2024. So which means the first the cost model, and the second is on before the first tax period. Now let's see the next life of the property is a 10-year. So annual depreciation is 10,000. Now the market value is 120,000. So what is the third point? What is the third point? Expected to sell at the profit. First, the second is this. Purchased or owned before the first tax period. And third, just for understanding, because here the value is a 100 and here the market value is 120. So third point, expected 1, 2, 3 is covered. Then we are seeing what is the qualifying asset. Okay. Now the second criteria is qualifying asset. So we already seen the immovable property. So this is immovable property. So which rule we will apply? Which rule we will apply? This rule we will apply. Under in transitional rule on immovable property, we have two methods. First method, direct method. Second is a proportionate method. Under first method, to calculate the excluded gain, transitional rule are different and unrealized gain and loss are different. So both are different. They are not the same. Just for your understanding, transitional rule are different, and the last session, the election, unrealized gain and losses are different. Do not combine together. Do not combine together. They are not the same. Okay, the first this is the calculation we have to do. Okay, the transitional rule at start of first tax period we have to calculate, and the second is at higher of. So let's calculate the gain. This is the direct method. Direct method, we are calculating what is the deemed market value. Deemed market value. Deemed market value is how much? At the start of first tax period. Okay. I'm writing with mouse, so maybe it's not appropriately writing, but the concept you already got, and mostly people are responding on that also. But quickly, I will just write the 120K. Now the cost, because we said the net book value or the cost, okay. The cost of the immovable property is I'm trying to write here because other participant also will understand what is the, here we have to choose the higher of. This is the cost and net book value. Just quickly, let me know what is the net book value. What is the net book value? Guys, what is the net book value? Because we asset is purchased on 1st of January 2021, 21, 22, 23. So 3 years. So let's say so 70,000 is our net book value. If 70,000 is our net book value, so higher off. So which one we will take it? Which one we will take it? Higher off. 100K or 70,000? Okay, we said higher off, so this is the higher off. So under the direct method, at the start of first tax period, what is the excluded gain? Okay, this is the first one. The second, proportionate method. Second is the proportionate method. The proportionate method, when we will do the proportionate method? In the year of sale. So when we sold? 30th June 2025. Company elected to record gain for CT, gain on realization basis using the accrual basis of accounting. So the second is 150, the market sold at market value. So market value, again, what we will take? Market value, again, higher of, and higher of will be so 50,000 is our gain under proportionate method. This is the direct method. This is the proportionate method. So guys, up to here, yeah, we all understand. Let's see. Excluded gain on disposal of assets. Method 1 on 1st January, deem value, exclude gain 20,000, just we calculated. And the second method is on 30th June, 50,000. Again, the 50,000, but next the apportionment method. We have to do the apportion. So now this apportion, you guys understand this apportion or no? Yeah, no, this already, it's the Bukhari already calculated. Yes. Now here, one of the point is optional. See, this direct or indirect, okay, sorry, direct or proportional, there is no election. There is no election. One of that you can take. But why we are doing this? Why we are doing this? Because we will see the difference. How much more gain to take as a exclude is good for us, or the less gain to be take as a excluded is good for us. Which gain is good for us? Here is 20,000 and here gain number of days. Number of days property is pre-owned. So I think the one of participant already calculated, but how many days property is pre-owned? How many days property is pre-owned? It's 3 years, right? 21, 22, 23, 3 years. So total number of days is 1,000. Now the second is the total ownership period. Okay, 3 years is owned, and when we sold, 30th June 2025 we sold. So we can add another 4.5, total will be 4.5 years. Okay, this is the denominator. The total is denominator, and here denominator how much is used. So why we putting the pre-owned number of, okay, here the important gain, this is the gain, from here is coming the gain. Number of days, the 3 year into 365 or 366. Here the 360 into 3. So this number of days is on at the first tax period, because what we are doing, what we're gonna do, this is what we're gonna calculate excluded gain divided by total day, ownership. This is the excluded gain. Now, what we do with this excluded gain? What we will do? This 20,000, this 33,000. Let's say we take this 33,000. What we will do with this? Anybody would like to answer on that? What we will do this? What will be our next course of action? How much already is added over there? How much the gain already in the city? How much the gain already is city? Would you please compute the taxable income? Would you please calculate the taxable income? Would you please calculate the taxable income? How we will calculate? What is our starting point? What is our starting point to calculate the taxable income? What is our starting point to calculate the taxable income? What is our starting point to compute the taxable income? Profit before tax. Do we have profit before tax here? Right? Gain and losses on realized basis. Okay, so now upon this, how much the gain already is included here? How much the gain already included in here? Profit before tax. Here election is off on the realization basis. Fine. So now we already sold in 2025 and we want to calculate the 2025 taxable income for 2025. So how much gain is already included over here? From that we will minus this gain. First, what we will do, we will see, continue from the same. Okay. So what is the depreciation? Depreciation per year is a 10,000 and asset is total life is a 4.5. So I'm just taking the 10,000 per year depreciation and multiply 4.5. So let's say this is the 45,000. So what is the asset value was 100. Net book value is 55,000. At the time of sale, net book value, just I'm considering the 55,000. This is the depreciation. Hope you guys understand how the depreciation. So minus. So how much the gain? How much the gain? 95. 95. No. Yeah, sorry. Asset is sold 150. Sorry, 150, not 120. Yeah, 95,000 is the gain. And how much the excluded gain? This is the excluded gain. And balance will be taxable in the current year. This gain belongs to the asset on before the first tax period. Let's see. Taxable gain. Asset sale 150 minus the net book value at disposal date 55. Guys, hope we understand this topic very precisely. Most of participant or most of the participant is active and they're solving along with me. Thank you guys. Thank you guys. This election we already known by irrevocable, and the first return will be submitted, and the valuation will be by relevant competent authority. The report will be there. Now, please solve this second part. Please work on this. Please work on this. Anybody would like to come forward and solve this? Anybody would like to come forward? Okay, let's see this example, cost model, profit before tax. Okay, again, the first point is covered. Realization basis elected, intangible assets. Now, this is not immovable property. This is the example for intangible asset. So under intangible assets, the cost is when intangible asset, the first, the cost model. Second is the intangible asset. If we, let's do the same exercise, transitional rule, where it will be applied, qualifying asset, where the cost model, purchased before the first tax period, and expected to sell in the future at the profit. Market value is here the 100 and here 120 at this first tax period. Okay. So we are expecting to be sell. The first point is covered. Then we are looking for which asset is this? Intangible asset. So under intangible asset, what is the rule? We will go only the proportionate method. we will go only the proportionate method. There is one more point under intangible asset. What is that point? What is that point? Quickly, guys, quickly. Guys, quickly that reply that. What is the other point that we have to see? So I believe you guys understand the concept now. I'm not let's move to the next. Method 2, exclude gain 150. This is the 150. This is the first tax period, the original higher off. We take the original higher off. The gain is 50,000. Number of days pre-owned. Okay, the same calculation. Now here the only the limit. What is the limit? The number of days pre-owned at the first tax periods, total number of days of the ownership. Okay, so this is the total number of days. Is this correct? Is this correct? The 50,000 gain, and this is correct. Why? Because we purchased the asset in 2010 and we sold the asset in June 2025. So this is almost 15 years, right? So we said earlier, we will exclude the gain, the pre-owned asset. Why we not took the 15 year? Why we not took the 15 year? Okay, guys, I think you already catch the point. Let's see the gain on taxable actual sales. Quickly, the same 4.5 over 20 year. The profit on this the excluded gain. I think this concept you already guys have it. Now let's ministerial decision 120. Ministerial decision 120. I think you guys go and search on the the Google and you will find this ministerial decision about the adjustment. Now the one example asset accrued. An asset is in a period prior to the first tax period. Here we will see the difference. We will see the difference of historical cost and the fair value. A taxable person acquired an asset in a first tax period and prior to the first tax period. While reading, we will understanding we are aligned first tax period, arm length 1,000. Now asset is recorded on historical cost, correct? Under the historical cost, asset is reported in the opening balance that we are discussing the balance sheet at the start of the first tax period for the same original cost, assuming no depreciation had previously been recorded. Okay, so it means same, even though the market value of the asset at the start of the first year is this. He's saying the original cost is 1,000 and the market value was 1,700, but still they recorded on the cost. So here we are saying the asset was purchased before the first tax period, cost model, and expected to sell on the gain in future. So during the first tax period, asset is disposed of for the 2,200. So we will calculate the excluded gain. Realizing the taxable gain, how much gain? This total gain. Why? How? Because 1,000 is cost. This is the sale value. This is the gain. The sale price to 1,200 less cost. This is the cost. Out of which relate to the prior period of the first tax period. How it will be coming? We know that from here. From here that we know that this 700 coming from here and 500 subsequent. So this will be part of the city computation. Let's see the second scenario. Asset is recorded on their fair value, on their fair market value. So this is just for understanding what will happen, what we will do. Considering the facts, if alternatively taxable person apply the fair value, the asset will be reported in his first opening balance on the same market value. If you report on that, So how much is our gain? Excluded gain. How much our excluded gain? The same. Why it was the excluded gain? Why this is we excluded from the city? Because here was the cost model. The cost model, even the market value is the same, but we did not record this market value in our books. Okay. In books, we did not record this. We did not record this. So that's why we have to exclude this gain. But here, this gain already, here the gain already, market value is already the same value instead of the cost, which means the gain already excluded. We don't have to calculate anymore the excluded gain under market value, under fair market value. The balance already there in the first tax period. The realized gain will be 500. Again, the same point, qualifying asset, the cost model, purchase before first tax period, the next is expecting to sell. I think we already repeat number of times. Now you guys understand this. There is one more example. After that, this topic will be covered. Okay, this one we already did. Now let's see the next part. Example 2, valuation method on qualifying immovable property. Qualifying immovable property. Company C has a first tax period from 1st August to 1st August 23 to 31st July 24. On 1st August 23, opening balance sheet shown the following in respect of an immovable property. Original cost 20 million, accumulated depreciation 3 million, net book value is 17 million. Immovable property was purchased on 1st August and assuming to be at arm's length and is measured on historical cost basis. Immovable property is a qualifying, immovable property is a qualifying immovable property. In the tax return of the first tax period, companies make an election for the transitional relief under the valuation method. Under the valuation method in respect of the immovable property. They already opt for the transitional relief. Okay. So while opting the transitional relief, so we have to give them the value also. We have to give them the value also because they opt for the valuation method. So what they will do, they will arrange the property value, immovable property, at the start of the first tax period. Step 1, company C obtain a valuation report from the relevant government competent authority in the UAE and the market value of the qualifying immovable property on 1st August 2023 as determined by the government competent authority is the 24 million. So now you can solve this and let me know what is the answer for that. Quickly. Yes, guys, are you working on that? Let's continue. As of now, we have the original cost and we have the immovable property. And immovable property, we have the valuation. The valuation, where it takes the 24 million. Then higher off, where I take the 20. Taxable income adjustment upon disposal. Taxable income adjustment upon disposal. Step 2. Company C sell the immovable property on 27 million. Market value valuation was 24 million, but now they sold at 27 million. On 31st, they sold 27 million. When they sold 31st July 2024. When its net book value was 16 million. Net book value also they give. So how much the gain? How much the gain is the accounting team recorded? 27 minus 16. 27 minus 16. Accounting team, how much the gain is recorded? 11 million. Following the depreciation, okay. Taxable income adjustment for the tax period of disposal, therefore. Now, please, now you already have all the information. Please calculate the excluded gain. How much will be the excluded gain? This 11 million is the gain that accounting team recorded in the financial, but now we have to the tax team as a tax professional or tax accountant, we have to calculate the excluded gain. How much will be the excluded gain? Now, how much will be excluded gain now? But here, if we calculate that the second method, so we sold at 27 million. So here the gain is 7 million. Earlier was 4 million. Here is 7 million. And from the how much the gain we will take? From 7 million, we will do the proportional method and apply, and then we'll take the excluded gain. Let's see. I'm not sure the guys you are. Let's see quickly. Sale price, this net book value is 16 million. Total gain is 11 million. Okay. Calculation of excluded gain, pre-corporate tax gain. Calculation of excluded gain, pre-corporate tax gain. Now the market value is 24 million as a direct method, but we are saying the valuation is a 20 million. Sorry, this is the valuation. 24 million was the valuation and the higher of 20 million. Okay. This is the first gain. Excluded gain, market value minus higher of original cost. This is the excluded gain. But this is the total gain. 7 million is a total gain, right? Total gain minus excluded gain. Oh, sorry. 11 million minus 4 million is 7 million. If 11 million gain in which the excluded gain is a 4 million, so now taxable gain is 7 million. But this is the first scenario. Now let's see the second scenario. Time apportionment method. That is the valuation method. That is the direct method. Taxable adjustment for the tax period of disposal will be as follows. Calculate the excluded gain, pre-corporate tax gain. calculate the amount of gain that would be arisen upon disposal of the qualifying immovable property had its cost been equal to higher of original cost and net book value at the start of the first tax period. That we already know the 20,000. This is sale value, this is the gain, we already knows. Now the divide the gain number of days immovable property on pre, so that we already knows. Number of days. How many number of days? I think one of the participants already did this calculation also. Guys, can you do this calculation? I appreciate if you make this calculation. From 7 million, okay, from 7 million, how much will be our excluded gain? See, if we go in terms of the valuation, then 11 million minus 4 million, okay? But if you go for valuation and here the asset is sold, so you would like to take the more gain or the lower side? So here we have to see what number of days of the qualifying immovable property is Hi, welcome back. I don't know, there's somebody else will be the host. Okay, guys, now we are already about to finish this. This is the same question, two scenario. We already discussed this. So let's close this. This ratio we already seen will multiply and it will be our excluded gain. Okay, this is our excluded gain. Now let's see the quickly. Company D, the taxable income adjustment for qualifying intangible asset. Company D is the first tax period from 1st August to 31st July 2024. The balance sheet is shown. The original cost 15 million amortization net book value. The intangible asset was acquired on the 1st August 2021. Here the intangible assets. Okay. The intangible asset maximum 10 year we can make the adjustment for excluding gain. Historical cost is meeting, and company D sell the intangible asset on 31st January 2024. Okay, at the year end, the asset is sold, and this is his first tax period against 20 million. Intangible asset was qualifying intangible asset. Okay, the word is qualifying. In the return of the first tax period, company D make an election for the transitional relief in respect of all its qualifying intangible asset. Calculate the excluded gain. Guys, quickly calculate the excluded gain and let's finish today's session. Guys, quickly calculate the today gain.
Recording in progress. Recording in progress.
Okay, let's see the answer of this. Calculation of the excluded gain. What is the excluded gain? What is the excluded gain here? Pre-corporate tax gain. Again, the another name for the excluded gain, pre-corporate tax, before the corporate tax regime, whatever the gain that is not subject to tax. So step one, calculate the amount of gain that would have been arisen upon the disposal of qualifying asset had its cost been equal to higher of the original cost and net book value at the start of the first tax period. So intangible asset, intangible, where is that? Intangible asset. Yeah. Intangible asset and only the direct method we can apply over the proportional method, higher of 20 million, 15 million. Hope guys, you asset is sold for 20 million. Original price is 15 million. Quickly, we are closing this. 20 million minus 15 million. 5 million is gain. Step 2, divide the number of days of the qualifying asset is pre-owned. Maximum is a 10, but this will not be the 10, and divided by total number of days. Here, we already have the detail. We did the calculation, number of days, then the total. Step 3, multiply the amount of calculated by calculating the step 2. B, gain multiply A. This fraction we already calculated by here the same. Instead of here we are doing the gain, we just put the A. Okay, we have the fraction. Now we have the 500,000 is the gain. Oh, sorry, the 5 million is the gain. This is our gain. Now from this computation, what is our answer? This much will be excluded gain. Step 4, the amount of gain on qualifying asset deduct from the taxable income. So this is the amount we will deduct from the taxable income. Okay, guys, thank you very much for today session. Anybody have any point or some quiz or something? And I would like to take the feedback for today's session. If quickly you guys share, how's today's session? This topic is understandable. You have some meaning or productivity, guys, quickly. Okay, guys, thank you very much for your participation, and we will take our next session on Sunday. If you have any question, even after session, you can send in the WhatsApp or on the same day of the next session. Thank you, guys.